Okay, Mark, I think I'm going to begin because I'm not sure if anybody else is going to join or not. And if they do, they can catch up, and then obviously the recording is there for anyone to listen to. So as I said this evening, just get this out of my way, we're going to go through the LU5 share valuation chapter tonight so that you guys know what's going on with share valuations, what the formulas are that you've got to cover, and the various other important things for Learning Unit 5 and how those calculations work, etc. And that's what we'll do tonight. And then we will then have finished our our 3 chapters for your second task, which is 3, 4, and 5. So I'm just going to put a reminder in the chat. Task 2 is Learning Units 3, 4, and 5. Okay. And then we've got 2 weeks then left up until your due date of the task 2. And what we will do then is, so what is today is the 11th of September. So the 18th of September and the 25th of September, those will both be kind of NSS weeks. So the next 2 weeks will be what we call the NSS weeks, which is when we go through past papers and past questions and get you ready for the assignment, and then any questions, last minute questions and tidying up we'll do in those 2 weeks. So that will be the 18th and the 25th of September. Okay, then your task 2 you will be doing on Tuesday, the 1st of October. That's your task 2 due date. So again, and I'll remind you closer to the time, midnight on the, 30th of September, midnight on the 30th of September or thereabouts, they'll release the task and you'll have up until midnight on the 1st of October to complete it. So if you just think of 1st of October as the day that you'll be busy working on the task, then I think that's the easiest way to think about it without getting confused about midnight this and when it's released, etc. Okay, so that will be our plan. So we'll have plenty of time to go through questions, past papers, and any other tidying up that we need to do. Hi, Amita, nice to see you joining. Welcome. Okay, so what I've got on the slides that we're going to have a look at here is to go over to, so that you can see what's important and how the Learning Unit 5 is split up into the different themes and what our learning objectives are. Yes, it will be released on the 1st of October, but it should be like just after midnight. So 1st of October, early in the morning, like say 1 a.m. on the 1st of October, the task will be released. And then you must upload it before midnight on the 1st of October. So they always say that the due time or the latest time for upload is 23:59. So the assignment must be uploaded by 23:59 on the 1st of October. Okay. So here we go. So in our Learning Unit 5, what we're going to add to our knowledge now, and remember Learning Unit 3, we looked at all of the principles of risk and return. So that's, again, remember what I said, one of our foundational modules that really gives us the foundations on which financial management is based, risk and return, balancing those two. Then Learning Unit 5, we started looking at interest rates, how interest rates are calculated, what our formulas are for interest rates. And then we looked at actually calculating the value of financial instruments called bonds. And now tonight we're looking at the valuation of a financial instrument called shares. So we're going to look at in this chapter then debt versus equity. So debt obviously meaning when a company needs to raise funding, raise capital, and this we're talking here about long-term capital for long-term investment in assets in the company that they'll use to produce income in the future. The company's got two ways to do that. They can either raise the capital through debt, which is through loans of some kind. There's various different ways a company can raise money in the form of a loan. Bonds being one of them, which we did in the last chapter. And or they can raise funds through the issuing of equity. So equity means ownership in the company. So whoever takes up equity actually becomes a part owner of the company. So when we sell shares in the company, we are actually, I don't know if you could really call it, giving away some of the ownership in the company. We're diluting the ownership of the current owners, and we're spreading the ownership of the company amongst more people, across more shares. So that's if the company issues new shares that have never been issued before. So this is what we look at here in this section, so that you guys understand the difference between and the characteristics of debt and then equity. So we'll look at the learning objectives specifically in a minute. Then we've got three ways, or three methods, let's say, that we use to calculate the value of a share in a company. And we can use, depending on what type of structure our company is, how big the company is, and sort of our purpose in doing it, we can use any one of the three ways. And often companies will, if they want to do these valuations, they'll do more than one of the calculations. They might even do all three of them, and then kind of get a balanced comparison of how the share valuation comes out with the different calculations. So the first calculation we can use is called the dividend growth model. And it has two formulas. We can either use the constant growth model, or we can use the variable growth model. And I don't know if any of you have got your formula sheets with you. Find this. But on page, on the second page of your formula sheet, and remember, I have advised you guys, the formula sheet's uploaded in your more resources. Definitely go and print it out so that you're working with that formula sheet, so you're very familiar with it. Not so important for the task, but very important for the exam. So if you've worked with your formula sheet throughout the semester, by the time you get to the exam, the formula sheet will be attached to your exam paper, and you'll be familiar with it, and you'll be able to use that formula sheet to your best advantage. So the dividend growth model, both the constant and the variable growth model, those two formulas are on the formula sheet. But remember also, formulas that are on the formula sheet, they give you the actual formula, but they don't give us the key. So if you don't know what each of those variables represent, then the formula is just as good as useless to you. So you need to work with the formula sheet so that you're used to using the formula without having the key underneath the formula like it is given to you in the textbook. So both of those are on the formula sheet. Then the second method that we've got for calculating our share valuation, or the valuation of our company, we're trying to put a value on the company so that we know how much to sell the shares for, is then the free cash flow model. So for the free cash flow model, we have got on the formula sheet also the formula for calculating free cash flow. So formula for calculating the free cash flows is on the formula sheet. But what's not on the formula sheet is the free cash flow valuation formula. So this is where I'm trying to make it clear. So in the free cash flow model, there are two calculations that are done. Number one, calculate the free cash flows. Sorry, that didn't want to work. The free cash flows. So that means the actual rand value of the free cash flow for each of the next, say, 5 years going into the future. And then secondly, we have got the free cash flow valuation formula. And that second one is not on the formula sheet. But because it is so similar to the variable growth model, you can use the variable growth model formula, which is on the sheet, and you can use that to then guide you in doing the free cash flow calculation if you need to. So don't forget that, and I'll show you closer to the time how to do that. And then the third one is the PE valuation model. So PE standing for, just like we when we calculated all of our ratios in second year finance, the price earnings model. So that is exactly what it sounds like. It's using the PE ratio, price earnings ratio, and we use that ratio to calculate the value for each share. Because remember, if you remember your PE ratio from second year, the P in the PE ratio stands for the current share price over, and the E is the latest EPS. Okay, so the P in the PE valuation is current share price over EPS, which is our earnings per share. So in the PE ratio, we have got that variable P, which stands for the current share price. So we use that PE valuation ratio to then solve for P, which is the current share price, and that tells us what our current share price should be. And then I've just put at the bottom here, because they're not really valuation models, but they are they're not really calculations in terms of formulas, but they are also two ways in which we can calculate the value of the company, and that is calculating the book value of the company or calculating the liquidation value of the company. So in your textbook, you'll see that there's a section in the textbook that goes, this goes chronologically through the chapter. Dividend growth, constant and variable, then followed by free cash flow model, then followed by the PE valuation model. And at the end of the chapter, we've got how to use the book value and the liquidation value to value a company. So these are the calculus. So this first bit here is really theory, debt versus equity. And then here we've got two formulas. Free cash flow model, there's two formulas, and the PE valuation model is one formula. And then the book value and liquidation are basically two methods. So those are the calculations you need to be able to execute from Learning Unit 5. Because again, they can ask us any of these. And in a 60 mark, sorry, your tasks are 100 marks. And in a 100 mark task, we don't know what they're going to ask us and what they're going to leave out. So then the learning objectives for Learning Unit 5, and remember reminding you the learning objectives are specifically the learning outcomes that they can ask you. So these are the things on which they will test us, and they're not allowed to ask us anything else other than these learning objectives. But at the same time, by giving us the learning objectives, they are telling us exactly what they're going to test us on. So we've got 6 learning objectives from this chapter. And again, the task won't contain all of them, but it will contain some of them. So these are the things that we have to be able to do. So they can give you a theory question where you've got to discuss or in some way contrast, differentiate between debt and equity capital. So that means you must show that you understand the definition of debt capital and the definition of equity capital and how they differentiate from each other. Then you should also be able to discuss the rights, characteristics, and features of share capital. So again, this is purely a theoretical section in your textbook, but this is a learning objective, these two. So either in the task or the exam, they can give us a theory question where we've got to be able to discuss those two. And then these next 4, apply, 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 apply. That means they'll give us a case study with some kind of data, and then we'll have to do a calculation using one or other of our formulas or models. So we must be able to apply the dividend growth model, both the constant and the variable growth ones. We must be able to apply the free cash flow valuation model using the free cash flow rand values that either they've given us in the data or sometimes we have to calculate them. Apply the PE valuation method, and then lastly, apply the book value and the liquidation value method. Okay. So if when you are doing your revision and your studying for this section, this is how you should divide your study blocks into, so that in each study block, what I would do is spend one study session covering these first 2 learning objectives, which is the theory, reading and understanding and making your notes so that you know you'd be able to answer those questions. And then spend one study session on each of these 4, the dividend growth, the free cash flow, the PE, and then the book value and the liquidation value. Don't try and cover them all in one session because there's no ways that you'll retain the detail. So I would definitely spend one evening, or I don't know how you divide your study sessions, but definitely a separate study session going over each of these 4. Okay, so this is just how the textbook divides it up into the themes. Sorry, not the textbook, Learn in the themes. So Learn has divided it into 2 themes. The first theme on Learn, theme 1, is the rights and characteristics of shares. And then the second theme on Learn is our valuation models, our 4 valuation models. So that's, please go on to Learn. There's such good information there, and good examples and good links that you can click on to go and watch a video or read an article that really help to boost and develop your, sorry, I'm just trying to set something here, and develop your knowledge on each of these things. It really does help a lot. So I hope you guys are using Learn to do that. Okay, so now I'm going to look at in more detail, and I will put, I'm not sure if I've put these 2 things up already, but if I haven't, I will put them up, these slides that we're looking at this evening, so that you've got easy access to refer to what you've got to do. So remember, these are kind of like guides to help you, as like study guides to help you work through the chapter. I'm going to make this, I don't want to make this too big. Okay, so, sorry, just give me 1 second. The beginning of Learning Unit 5, My book is pretty old. My Learning Unit 5 starts on page 117, but I'm sure the newer books are probably different. Okay, Learning Unit 5 Share Valuations. So the way I've structured this lesson plan is so that you can use this lesson plan to guide you through the textbook, showing you on the left-hand side here, this first column. I don't want to make this too small so that you can't read it, but I will upload this document for you so you guys can access it. So in this first column down the left-hand side here, these are the learning objectives. Then in this next column that says textbook reference, this tells you where in the textbook you will find the information that will cover that learning objective. As I say, these page numbers might not be 100% correct, but these section numbers definitely will be. So this is section 5.1 and 5.2, which is 5.1 is our introduction, and section 5.2 is the section headed Debt and Equity as Sources of Funding for a Business. And then for that lovely theoretical question that they love to ask us in tests, take note of the table on page 119 in section 5.2. So it's an actual table in your textbook with the left-hand column headed debt and the right-hand column headed equity. So to study for that theory question, I would use that table because the learning objective says differentiate between debt and equity. Here on the screen, page 119 to page 118 to page 119. The table is on page 119. If you've got a newer textbook, it might not be exactly that page number, but just look for section 5.2 in your textbook. It'll be the very first page of the chapter. Have you got it? Okay, awesome. So that table is what you must use as your to learn and study. In other words, if you have a look on the left-hand side here, our learning objective says differentiate between debt and equity capital. So this table is set up with the characteristics of debt, 5 characteristics of debt on the left-hand side, and then with the contrasting 5 characteristics of equity on the right-hand side. So that's what you must learn, is that table to cover that learning objective. Okay. And then right underneath that, the next section in the textbook, this is section 5.3. Section 5.3. Guys, for making the screen or the slide bigger on your side so that you can see it, at the top of your screen you'll see you've got the magnifying glass. So on your side you've got to increase that magnifying glass to see it. It doesn't work if I do it on my side. So you can control the zoom in or zoom out on the screen on your side. So you'll see section 5.3, the very next section in the textbook, is headed Rights and Characteristics of Shares. So that covers then our second learning objective, which says discuss the rights, characteristics and features of both ordinary and preference share capital. So that is, and again, I wouldn't learn, it goes on over a couple of pages and you don't need to learn that all off by heart. But as long as you understand in general rights and characteristics of shares, especially specifically ordinary shares versus preference share capital, that's really what the emphasis is there. And if you have a look at example 5.1, that will also help you to understand where to find the share capital in our statement of financial position, in our balance sheet, and how that is structured. So the textbook first discusses ordinary shares in 5.3.1, and then in 5.3.2, it discusses preference shares. So you must be able to discuss ordinary shares and then to contrast that with preference shares. But again, you don't need to go mad and learn all of those pages off by heart, because they won't ask you long questions there, but they do often just ask for contrasting description, etc. Okay. So on this third column over here, this is VC Learn activities and textbook questions that will help you to then practice these specific learning objectives. So this textbook reference tells you which sections in the textbook cover the learning objective, and this section, this column here, gives you specific examples, questions, activities on VC Learn that you can then use to practice that specific learning objective. Okay, so for instance, if you go onto VC Learn, you go onto learning units and you go to learning unit 5, and then you click on theme 1 of learning unit 5. There is a video under the graphic that discusses the debt equity ratio and leverage, etc. So that's the kind of thing that's just a nice way of learning the material that we've got to learn without having to just read it in a textbook. And then also on Learn, if you scroll down and if you do activity 5.1.1 on Learn, that's a test that will then test whether you've understood debt versus equity. These little tests are usually short. They're not usually very many questions, maybe 5, maximum 10 questions, and just like little multiple choice tests, but it does help you to work out whether you've understood and what you've remembered. Okay, and that's a self-marking test. So I'm not going to go through every single detail on the slide, because you will have it and you'll be able to read through it and then follow these guidelines, which will take you through the material. Okay, so that one, as I say, very theoretical. And then we come to theme 2. So on Learn, it will be under theme 2. So again, if on theme 2, you go to learning units, learning unit 5, and then scroll to theme 2. And this is where the valuation models are covered, which is our calculations. So we know that our first valuation model is then the dividend growth models. So again, in your textbooks, you'll see section 5.5 in the textbook is headed valuation models. And then, 5.4 is headed valuation models. And then there's just a little introduction to explain what a valuation model is and how it works and why we use them. And then section 5.5 specifically discusses the dividend growth models, both the constant growth model and the variable growth model. So the textbook is beautifully laid out, and it takes you through each section that you have to know. And in each section, you have got examples that you should work through carefully. Make sure you understand the examples, because the examples are there to illustrate to you the principles of whatever it is, whichever section it is we're doing, and to give you an example calculation that you can follow to then make sure that you've understood everything. And then following that, there will be questions in the textbook. So what I'm saying is, following, you'll get the written section, you'll get an example to illustrate the calculation, and then you will get a question that you can then use to practice that specific model. So if you, excuse me, I've been talking a lot today. So what I'm trying to say is the textbook is very nicely laid out for you to work through in a methodical manner, and you'll know that you will have covered everything that you need to know for the test and the exam. So if you go and have a look in your textbooks then at the formulas, we start out in the section just above example 5.2, where we've got the constant growth model. So our constant growth model says P0, that's a 0, not a letter O, is equal to D1 over K minus G. So P is the share price. So what we are calculating, what we want to calculate is the value of one share. i.e. the share price. So these are theoretical share prices that we are calculating. So we use these valuation formulas to give us an idea of what the share is worth. Then you would compare that valuation to what the current market price is, and that can then help you to decide whether it's a good time to buy that share or whether at the moment the share looks a little bit expensive. Because if the current market price is way above what the valuation comes out at, then it would appear that the share is probably overvalued. But if you calculate, you use your formula and you calculate a share value, and the current share price is lower than that value, then that would indicate that it's a good time to buy that share, because currently in the market price, the share is being sold at less than its true value. But remember, this is all theoretical. It's not written in stone. So that's why we've got various models that we can use, because we can't point to one valuation method and say use that and that will tell you what you should pay for the share, and that you shouldn't pay any different price. There's lots of other considerations that come into it when we're doing these calculations. So what we're really doing there is we are calculating the present value of the future dividend cash flows that are going to be generated by this share. If you look at that formula, so PO, in other words, the share price is equal to, D stands for dividend, and we call it D1 because we want to use the next dividend that is going to be paid. So in other words, not the current dividend that has just been paid, but what we estimate the next dividend value will be. So that's why it's called D1. Sometimes in a formula you will see the variable D0. So if you see D0, that would indicate the latest dividend that has already been paid. D1 means the next dividend. And then D1 over K. So K is equal to the required rate of return. So we are basically saying the investor that wants to buy this share, what return does he require? What percentage return is he expecting from this specific investment? And if you remember, right at the end of, is it chapter 4? Let me just quickly remember where we get that formula. Is at the end of chapter 3 or chapter 4? Right at the end of chapter 3, we have the CAPM formula. That CAPM formula calculates the required rate of return of the investor. So we will use the CAPM formula to calculate the value of K if it's not given to us in the question data. That's a very important bit of information, because often a question will we'll need to use the this dividend growth model, constant growth model, and we've got the formula, but then we have a look at the information that they've given us in the question, and they haven't given us the investor's required rate of return. So then we say, okay, so then what must I use for K in the formula? They haven't told me what his required rate of return is. Then if you have a look at the information for the question, you'll see they will have given you information like the risk-free rate of return, the market return, and the beta of the investment that you're interested in. And then using that information and the CAPM formula, we can then calculate the value for K. They often use that in questions, so just be aware of that. And then G is equal to the future growth percentage of the dividends. In other words, by what percentage do we expect the dividend payout to grow each year into the future? And I don't know if you guys remember from Learning Unit 2, Time Value of Money, we had the perpetuity formula. And you will see that this PO equals D1 over K minus G. It is basically the perpetuity formula. So we are PO, we are calculating the present value of a perpetuity. The present value of a perpetuity is, if I go present value of a perpetuity, the formula is equal to PMT over R. Do you remember that? Does it ring a bell? So remember, PMT is what is the regular annual future payment that you will be receiving from that investment. In other words, a perpetuity means I will be receiving a value every year into the foreseeable future. So we will receive a dividend payment every year into the future if we own a share. So D1 is just another variable name for PMT. And then PMT divided by R, in other words, R is the percentage return that that investment will be giving us. Remember, R is the percentage. So K minus G gives us a percentage. We use K, which is the percentage required return of the investor, minus G, which is the future growth rate of the dividend. So K minus G gives us our value for R. K minus G is equal to R. Okay. So you can see again how very important Learning Unit 2 is, because we're using those present value calculations in all of the valuations that we're doing. Remember when we went through the bond valuations, we saw that the bond valuation formula is basically made up of the present value of an annuity plus the present value of a lump sum formula. And now our dividend growth model, the constant growth model, is basically using the perpetuity formula. So all of this stuff, the calculations that we're doing are not brand new. You've come across them already in terms of formulas in Learning Unit 2. So just bear that in mind and go back to Learning Unit 2 and tie the two together, your formula that you're learning now with the formulas that you learnt in Learning Unit 2, and that will help you to then understand the calculations that we're doing in these valuations. Guys, any questions yet? Anything that you want to ask me? My aim here is just to really help you to be able to. The volume of the work that we've got to do is large. So my aim is to help you in these sessions to be able to tackle the work and understand it and organize it in your study sessions so that you can get through it with understanding and be able to cover everything. Okay, so then let's have a look at the dividend growth model. So we've got the constant PO equals D1 over K minus G. That's the dividend growth model with constant growth. So constant growth means that we expect our dividend rand value payout to grow at a constant percentage every year for the foreseeable future. So if we say the dividends are going to grow at 2% every year, constant growth means they're going to grow at 2% every year from now until the foreseeable future. But sometimes we've got what we call the variable growth. So here we say that the dividend payout is going to start out by having a high initial growth period, meaning that for the next, say, 5 years, the dividend is going to grow at, for instance, 5% per annum. Thereafter, after the 5 years, the dividend will then go back into that constant dividend growth pattern at a lower percentage. So we've got a high initial growth period, and then we've got, what do we call it? I don't like the description. The textbook says end of the initial growth period. I'm just going to say the period continuing after the initial several years. And then that would then be the perpetuity. So if you look at your formula under section 5.5.2 in the textbook, let me go over here. Okay, so in our lesson plan on the screen, variable growth, example 5.3 is then your example for variable growth model. And I just need to go back, and your question in the textbook is question 5.1. This question tests the variable growth model. Okay. So if you have a look at the variable growth model, you'll see that this formula, it looks quite similar to our bond valuation formula from Learning Unit 5. It also consists of 2 parts where we're doing one calculation and then adding it to a second calculation. So with the bond valuation, we calculated the present value of an annuity, which was the PMTs generated by the bond every year until its maturity. And we added that to the present value of the lump sum of the maturity value of the bond. Now with the dividend growth model, we are going to initially calculate the present value of the dividends during the initial growth period. So this is in terms of what type of cash flow pattern it is. Remember in Learning Unit 2, you had to be able to recognize the different cash flow patterns so that you knew which formula to use. This is an example of a mixed stream of cash flows. Meaning I am getting a cash flow every single year, but the rand value that I receive each year is different. It's not exactly the same. When we talk about an annuity, where with the bond, we calculate the present value of an annuity. We use an annuity when the rand value of the constant annual payment is the same each year. With our share, because the dividend payout is going to increase, hopefully, every single year, the rand value of the payout is different each year. So we can't use the annuity formula. We use the present value of a mixed stream of cash flows formula. So when you look at the formula in your textbooks, it probably looks extremely daunting. But if you know what you're looking at, then it simplifies it. So again, our dividend growth model, variable growth, says P, the price P0, meaning the price of the share at time 0. And remember, time 0 is always now, today, current, is equal to the present value of the initial, say, 5 years dividend payouts plus the present value of, and again, it's going to be the perpetuity, which is the same as, in other words, the second half of the variable growth model is the same formula, similar formula to our dividend growth model, constant growth. Okay, so it's just those two present value calculations added together. Your first calculation is the present value of your initial mixed cash flow added to the present value of a perpetuity. And the second one is a perpetuity because we then assume a constant growth into perpetuity. I don't really like the way that they've got the workings laid out, for example, 5.3. So if you go to, where's my question? Your question 5.1. If you go to that solution, the solution for question 5.1 in your textbooks at the back in the solutions. Just quickly find it here in my textbook. You should use that format for setting out your answer. So rather don't use the example 5.3 format. And you'll find it much easier to get the answer correct if you use that question 5.1. You see your answer is neatly laid out in a table. It's easier for you to remember how to lay your answer out. And it's also going to be easier to do your calculation and to follow all of your workings. Okay, so use that question 5.1 to do that calculation. Guys, we're coming to the end of our session. So what I'm going to do is I'm going to post this lesson plan for you in your more resources. And it's got all this information on it that you can then print this out, and then it's just 2 pages, this lesson plan. It's only 2 pages. So print it out and then use this to work through your learning unit 5. Because as you can see here, we then, after the constant and variable growth model, we follow on to have a look at the free cash flow valuation model and how that works. Mark, the formula sheet is already posted in your more resources. I'll go and double check, but I'm pretty sure I've already put it there. If you go, excuse me, if you go and have a look in your more resources, you'll go and see all the stuff that I've put in there for you. If it's not there, I'll definitely post it for you, but I'm pretty sure the formula sheet's already there. Okay, after we finish here, I'll go and have a look in the more resources, and if it's not there, then I'll put it there so that you've got it definitely. Okay. So as I say, guys, there are 4 different valuation models plus that book value and liquidation value. So it's a lot to go through. We can never hope to cover all of that in 1 hour. So that's why I've put this little sheet together, because then it's kind of like having me there talking you through the textbook and explaining the different models as you go through. So remember also, as you work through these questions and the examples, if there's anything that you don't understand, like how did they calculate this or why did they do that? Because sometimes in the textbook, in the calculations, they sometimes leave out a step because they assume that you'll know what it is. So if you do get lost in any of the calculations, please just send me a message, let me know, ask me to help you with what all the steps are or what they've done, and then I'll be only too happy to help you, to give you the extra information that you need. Okay. So anytime, because remember, we only see each other once a week. So anytime you're busy working through the info and there's something that you want to know, please, please send me a message, email, whatever, and I'll gladly help you. We're available for questions all the time. Okay, guys. Amita, any questions from your side? Mark is all clear. You're okay. And Amita, also not from you. Okay, guys. So best of luck with this learning unit. There is a lot of work in this learning unit, much more so than the bond valuation learning unit. So you will definitely need to spend a lot of time on this learning unit 5 compared to the other 2 learning units that we've already done. Okay. Okay, guys. Awesome. Have a good time. And have a good week until I see you again next week, and then we'll start next week. We'll work through some questions. Okay, some past paper questions, etc. Okay, guys, thank you very much, and I'll see you next week.